Hello and welcome to this video of the Alalibo Academy. In this video, we are looking at the regressive tax model, which is a very interesting tax model out there. There are many tax models, and this one is a very interesting one because it's very unique and it's applied evenly across the board. Now, let's take a closer look at this. It says here that regressive taxes do not depend on income. Right, so they are independent of income as they are applied evenly, and this is the key word here, please. Evenly is the key word here. It doesn't depend on income, right? So it's independent, right? Independent of income, and it's applied evenly to all, no matter the level of income, right? And this is the unique aspect of this type of taxation. It is applied evenly across the board, regardless of income, regardless of circumstances. It doesn't matter. It's applied across the board. Now, it also goes on to say this tax model affects the low income earners, right? The low income earners are impacted more with regressive tax model than it does higher income earners. I will begin to ask the question, why is that? Now, let's take a look at this example here, right? So GST, which is a tax in Canada, the federal government tax in Canada, is 5%, right? It's 5%. Now, there are two individuals. The first one goes out to buy a bike for $500, and that person makes $700 a month, right? And paying 5% of $500 is $25. Now, $25 is also paid by the second person who buys the bike at $500 at 5% taxation, and that person pays $25. Now, the second person makes $2,000 a month. The first person makes $700 a month. They both pay $25 at 5%. But here is the difference. The $25 paid by the first person translates to 3.7% of their monthly income. 3.7% of their monthly income, which is quite a bit. If you're making $700, $25 impacts your income, as opposed to 1.5% for the person making $2,000 a month. Now, 1.5% is 100% less. Than more than 100% less than the 3.7% paid by the person making $700. Now, this is how the regressive tax model impacts those that earn the lower income than it does those that earn higher income. Again, $25 means more to the person making $700 than $25 meaning more to the person making $2,000 a month. And you can see the impact in terms of percentage, clearly way more than 100% here we're talking about. Now, this is regressive tax model, a very interesting, unique tax model out there that does not take into consideration the income. So that's why we say it's independent of the income, doesn't take into consideration the income of the person. Everybody pays a flat rate, and that's why it's called inequity, right? There's no equity here. There is no fairness here. It doesn't, again, consider circumstances in terms of taxes. Everybody pays the same amount of taxes. And that's why this is known as the inequity tax, right? There's nothing equitable about it. It's not fair. It is based strictly on a flat rate. And that's why we say those that make less money are impacted more by this type of taxation, the regressive tax model.